Hello, I am John Najarian, and RebelCon 2022 is almost here. We do have a virtual pass. The virtual pass gives you full access to everything, all the streams, the live trading sessions, all of our fabulous keynote speakers. So to learn more about what's going on at RebelCon 2022, whether you're in person or virtual, check out marketrebellion.com/Dallas.
Hello, Market Rebels, and happy Monday, everyone. And I hope everybody had a great weekend and another big day in the markets. So it looks like the S&P was up a solid % going into the close. And what's important here is that this marks the second candle where we are above the 5,100 pair for the moving averages. So if we can stay above that, that could be very significant. Tomorrow, though, we do have CPI coming out at 8:30. Consensus is minus 0.1% for month over month and plus 8% year over year. Of course, there are ranges that are the kind of an expected range, but if we fall outside of those ranges, we could see some significant market movements, whether up or down. So that's something to watch for at 8:30 tomorrow. For today, if you've been with us for the past few weeks, we've talked about various topics. We've even gone into some fairly advanced topics such as put-call parity, synthetics. But I wanted to back it up a little bit, especially for our new traders, and talk about one of the most fundamental concepts in all of options trading. And that is rights versus obligations. Now, this sounds so basic that most people blow it off and they say, why would you even have to study this stuff? Well, I'm going to show you how easy it is to step into traps without understanding it. But it's, again, at its very core, this is really what the entire market is about. So, important concepts. So, rights versus obligations, what are we talking about here? Well, buyers have rights. So, if you buy an option, whether it's a call or a put, you have some type of a right. If you sell an option, you have some type of an obligation. And that's important to remember. A lot of times people bang on about sell options, sell options, sell options. Yeah, there's some benefits to it, but there's also trade-offs. Yes, you get positive theta, but you've also got negative gamma and negative vega. You've got obligations. So just always remember, buyers get the rights, sellers have the obligations. And if you just remember those two facts, it will go a long way into helping you understand strategies and risks. So here's a way to figure it out for those who might be fairly new, is to start with a little grid like this. And just remember that if you buy a call, you have the right to buy. And if you buy a put, you have the right to sell. So most people can figure that out. The buyers have the rights. It's where they get tripped up is on the sell side. But watch what you can do. Just look at the opposite side of the trade. If you sell a call, you have the obligation to sell shares for the strike. Take a look. Opposite of right is obligation. Opposite of buy is sell. The person on the other side of the trade has exactly the opposite characteristics. If one's a debit, the other's a credit. If one's an asset, the other's a liability. If one's bullish, the other's bearish. Everything is opposite. Take a look at the puts. If you sell a put, you have the obligation to buy. How do you figure that out? Opposite of right is obligation. Opposite of sell is buy. So if you just remember these little kind of building blocks, it will go a long way into understanding strategies. So let's take a look at some vertical spreads. So for instance, let's say that you buy a $100 call and you sell a 105 call. In the business, we would say that you are buying the 100-105 vertical call spread. And let's say that it's executed for a net debit of 3. That just means that the net cost between these two is a cash outlay of $3. Well, let's answer some basic questions. Is it bullish or bearish? And what are the max gains and losses? In a previous trading tune-up, I talked about cheap versus chicken, kind of a comical way to understand what's driving a strategy. So you can go back to those and take a look here. Remember that lower strike calls are worth more money. All right, so between these two, we have the 100 and we're selling the 105. So just focus on the lower strike. And this is true even if we had different expirations. What are you doing with it? You're buying it. You are buying a call. Forget about the spread. Forget about the word spread. What's driving this strategy is that you are buying a call. How do I know that? Because I'm looking at the more valuable strike. And then I look at whether it's long or short. So I can answer this question down here. It is bullish. But what about the max gains and losses? Well, we've got a net debit of 3. And here's where you can go back to your rights versus obligations. I have the right to buy at 100 when I bought the 100 call. And I have the obligation to sell at 105. That's what happened when I sold the 105 strike. So think about what happens if we buy shares at 100 and if we sell them at 105, that's potentially worth $5. You've heard me talk about assets and liabilities and vertical spreads. I would say that this is an asset spread. It could potentially grow in value. Yeah, it's worth $3 right now, but it might be worth $5. And so there's your answer. If we pay $3 for it now, but it might be worth $5, the net possible gain would be $2. And again, that's because it is a debit spread. It's an asset. Let's take a look at another long vertical. Let's say you buy the 105 put and sell the 100. You would be buying the 100-105 vertical put spread. And again, let's just say it's a net debit of 3. Let's answer the same questions. Is it bullish or bearish? And what are the max gains and losses? Go back to cheap or chicken, go back to your pricing principles, take a look at the strikes. For the put options, higher strike puts are worth more money. I don't care about the expirations, I'm just looking at the strikes. I can see that the 105 is the higher strike. What are you doing with it? You're buying it. So what's really driving this strategy is you are buying a put. If you're buying a put, it's bearish. All right, so we can answer this question. It's a bear spread. But what about the max gains and losses? This is where you can go back and look at your rights and obligations. If you buy the 105 put, you have the right to sell stock at 105. If you sell the 100 put, you've got the obligation to buy at 100. But look what's happening. You're ultimately buying at 100 and selling at 105. Or you could think of it as shorting shares at 105 and buying them back at 100. You're just doing it in the reverse order that we just saw with the call spread. But it still means if you're buying at 100 and selling at 105, that it could be worth potentially $5. It's an asset spread. It can grow in value. So yeah, right now we paid 3 for it, but if it turns out that it can grow to 5, the net to us is 2. Just always looking at rights and obligations. All right, so now let's take a look at a short spread. Let's say that you sell the 100 call and buy the 105 call. We would say that you are selling the 100-105 vertical call spread. And let's just give it a number here. Let's say that you get a credit of 2. Again, same questions. Is it bullish or bearish? And what is the max gain and loss? Well, here I'm going to go back and take a look at the strikes. Lower strike calls are worth more money. So immediately my eye is drawn to that. I can see that the 100 call is driving it. What are we doing with it? We're selling it. What's your outlook if you're selling a call? Well, that's bearish. So I can see that this has a bearish bias to it, so we can answer this question. But what about the max gains and losses? We got a credit of 2. How do we figure this out? Well, I've got the obligation to sell shares for 100 when I sold the 100 call, and I have the right to buy at 105. So now you should be able to figure it out. If you sell stock for 100 and buy it for 105, or if you buy it for 105 and sell it for 100, it's a $5 loss. And that's where a lot of traders kind of stumble on the credit spreads. They don't realize that it's a liability. And that doesn't mean it's bad. It's just that you're not getting a credit to collect an asset. you're accepting a liability. So now that we know that this could potentially be worth -5, that's the best it can do, is to lose. I shouldn't say it. It could expire worthless, but this is, it could never grow in value. It's just a liability that could potentially go against you by 5 points. So now we have to say, all right, I could potentially lose 5, but if I got paid a credit of 2, then that would be a max loss of 3. All right, so you can see that it doesn't really matter if you bought the put spread for 3 or if you sold the credit spread for 2. It's the same thing, 2 different ways of saying the same thing. So again, what I wanted to show is just by understanding rights and obligations, it will make it a lot easier to step through strategies. Now, here's where you can step into traps. Let's look at some misperceptions. Let's say that you buy a 30-day $100 call, you spend $5. I see this a lot from traders making this mistake. And at a later time, the stock has now fallen a couple of points. You know, it was at 100, now it's at 98, and they go, oh, I'm on the wrong side of the trade, it's falling. What should I do? Well, they turn around and rather than maybe taking the loss, they say, let me try to fix it. Let me sell this 95 call, which we know is worth more money. And so the 95 call is $6. So they reason this way. Well, if I paid 5, but I collect 6, I'm up $1. I'm in a guaranteed position. Is that really truly a guaranteed dollar gain? I hear this all the time from traders. Well, it is true that you have a credit of 1, but you've got an obligation of 5. Look what happened. You have sold the 95 call and you bought the 100. Yes, it's true you didn't do it at the same time, but that's irrelevant. This is what you ended up with. You're short the 95 100 vertical spread for a net credit of 1. So you have a max loss of 4. There is no guaranteed gain of $1. And yet that's what people think. They go, oh, I've got this guaranteed gain and I might make more. It's not true. So here's what you've gone into. You've kind of morphed into this bear spread for a credit of $1. And look at where the stock is. I said the stock was at 98. All right. So if the stock is 98, you need that stock to fall if you're going to get into profitable territory. Let's look at the current curve. So you can see if the stock falls, yep, we can make some money, but if it rises, we're going to start losing. But we also have to weigh this against the opportunity cost. What did we give up? We had the long 100 call, which looked like this. This had unlimited gains if it rises and limited losses if it falls. So you can see that right now it didn't really do a big difference for you. You're still sitting here at this intersection between the green and the blue. What you've done is you've switched your opinion from bullish to bearish. But what I find is a lot of times traders don't do it. They go, oh, I was just able to get into a free trade because I've got this net credit of $1. But if you go back to rights and obligations, you'll see that's not true. You do have a credit of $1, but you've now entered into a $5 liability. So I hope that helps you to understand some of the strategies as we start looking at more advanced ones. We'll come back to this. You'll see it's something I use all the time when teaching strategies. So again, it's not about memorizing strategies. It's about understanding what makes them tick. And that's when you're going to find the opportunities. So for anybody who'd like to learn more, we'd like to invite you to have a free coaching call. Yes, free with one of our world-class coaches. The phone number is 888-809-8058. They'd love to have a chat with you. Any topic that you'd like, they can take a look at your trading styles, maybe your particular trade, and they can give you tremendous insights into how you can make better decisions. And that's really what it's all about. So again, I hope that helps. And I hope that everybody can join us for Thursday and Friday this week. Again, 4 p.m. at the closing bell. And we'll look for you then. Thank you so much.